Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford, one of the managing partners with PassiveInvesting.com. Glad that you're here with us today. We have two special guests here with us today. We have Michael Vaysman and Mike Sanghvi with us today. Welcome, gentlemen.
Hi, good to be here.
Hey, Dan, good to be here.
Awesome. Well, I'm looking forward to diving into this asset, 88-unit asset out of Huntsville, Alabama, called Pinetree Village Apartments. You guys closed this thing in December of last year in 2021. Before we dive into that asset, let me turn it over to you, Michael, and have you give a little bit of an introduction of yourself, your group, and your background, and kind of where you are right now in the multifamily space.
Yeah, absolutely. Thanks so much. So Standard Capital is a partnership between myself and Mike. We're focused pretty much exclusively on workforce housing throughout the Southeast and build a little niche for ourselves in that 100 to 150 unit multifamily complex. We're really focused in the secondary markets, Huntsville, like this deal, Chattanooga, Lexington, markets with a couple 100,000 people, but they're not Atlanta or Nashville, where we seem to have a lot of supply and more competition. So that's really been the niche for us. We have an institutional background. So Mike and I both used to work in the private equity space. We were doing that for a number of years, transacting how many thousands of units, large development deals, large value add deals. And eventually we said, hey, we can, we know how to do this. Can we do it on our own? And that's exactly what we did. And so we've been buying in the Southeast for a number of years now. We've built up a portfolio in the Southeast and expect to keep doing that as well.
Awesome. Well, thanks for that introduction and that background. Looking forward to diving into this asset here, this 88-unit asset out of Huntsville, Alabama. So without further ado, let me just turn it over to you and share with us kind of how you originally kind of found and sourced this acquisition.
Yeah, I could take this one, Dan. So we've been active in the Huntsville market for 5+ years. We've owned 4 properties already before we got this under contract. On this one, we've been pursuing this one off market through a broker that we had closed 4 previous deals with in Huntsville. It wasn't shown to anyone, so that was good. But the seller was a bit unmotivated on this one, and it made it really tough. It took us about a year to get this one tied up. We initially submitted our LOI in, I believe, November of 2020. We even started negotiating the PSA right after that. We were on the 1 yard line to get that signed until the seller said, oh, I'm going through some major life changes right now. And he also invested a 1031 into this property 9 or 10 years ago. So when he, estimated his tax bill, he became even more unmotivated. So he pulled the plug at that point. And then Michael and I were just super persistent, following up every couple of weeks, every month with the broker that we have a good relationship with. And we were able to re-engage him and get the PSA signed in September of 2021. And obviously we closed in December after that. So it took a full year to get this tied up, basically.
Well, it's definitely a lot of consistency on your part and diligence to try to get this one to that particular phase. So walk us through kind of that last, before you got it, the actual PSA signed, walk us through kind of what are some things that you had to kind of go through to kind of get to that point. Obviously you mentioned following up with the broker and kind of staying in contact with them, but was there like an initial offer that you made in the very beginning and it just kind of sat on their desk for a while, or kind of what was that process like?
Yeah, like I mentioned, we even got to a stage where the PSA was almost executed. It was on the 1 yard line. There was a couple issues that we were still negotiating. One was like specific performance. We absolutely needed that in this market, and the seller was not willing to give us that. And there was another issue with some reps and warranties, with him repping the accuracy of the financials and the rent roll, which we obviously absolutely needed as well. So we kind of broke it off at that point. And then as we, remained persistent on this, only thing that changed from then till September was the purchase price. The market had moved quite a bit in that year, which we acknowledged. So we ended up increasing our purchase price, which really motivated the seller at that point to transact. He did keep all the other terms the same otherwise, which we felt really good about.
So from a term perspective, walk us through that a little bit as far as kind of the final purchase price that went through, but also
Mhm.
the earnest money deposit and the terms for due diligence and extensions and those types of things.
Yeah, so the final purchase price for this was $10 million for 88 units. It was about 113,000 per unit. It was a typical DD, 30-day DD plus 30-day closing with a 30-day extension. We were fortunate that we did not have to go hard day one, so we were happy that the seller honored our the initial terms that we had in 2020. The earnest money deposit was $100,000, but again, that went non-refundable after the diligence period was completed.
So the 1%, kind of EMD was put up the day you signed, or within a few days of signing the PSA,
Mhm.
but it didn't actually go hard until after the initial 30 days of due diligence.
Right.
Okay. And let's see, September, October, November, December. So it looks like you also executed the extension on this one too. Is that correct?
There, given the seller had that 1031 that he rolled in, he wanted to extend it a couple weeks. So we just being a good counterparty, we accepted to extend it 2 weeks for him so he could purchase his other property and get that teed up as well.
Okay. So just kind of gave him a little more flexibility on his down leg, if you will.
Exactly.
Okay. And as far as the kind of offers on this one, I know you mentioned kind of there was an initial kind of offer, even PSA, and then kind of went back at it and increased that offer. Kind of where
Mhm.
was that initial offer that you had first put on there, and kind of what that guidance was then to where what it actually ended up being?
Yeah, he initially accepted $8.8 million in 2020, and then we ended up increasing that to $10 million for him not to take it to market or shop it with anyone else and so on. So we were the only counterparty that he was negotiating with.
Okay. And then you said it was still through the broker, correct?
It was still through the broker, exactly.
Okay. And at what point in time did you and your team actually tour this property?
We toured this. So, given we've been in Huntsville for 5+ years, we've toured this multiple times. So, we toured this initially back in 2020 when our LOI was accepted. And then we toured it again in 2021 just to make sure nothing crazy has happened, like a building is burned down or anything like that before we get under PSA. And then we obviously conducted our full due diligence right after the execution of the PSA as well. So, we've toured this asset, I would say, multiple times.
So at what point in time did you look at this deal and go, we got to get this deal? Or had you already known about this deal enough that you were kind of already excited about it before you even, really doing a lot of due diligence or kind of taking a deeper dive on it?
Yeah, I mean, this is a typical story of, kind of being the ugliest asset in one of the best submarkets in Huntsville. This asset just hasn't gotten much love in the last couple decades, but it's an amazing submarket. Great demographics, great schools, at median incomes and so on are just amazing in the submarket, but also really limited multifamily in the submarket. So we knew we wanted to own something here, and that's why we were so persistent.
And what makes you so excited about this asset? Like, obviously there had to have been some sort of major business play, obviously, improving it from where it is today to where it's going to be, but kind of what's the overall business plan for this particular asset?
Yeah, the business plan is, doing our typical value add plan. We will be investing over $1 million into this property. Like I said, it hasn't seen much love in a couple of decades, so that's a pretty holistic value add plan. We're doing everything from adding amenities, improving amenities, to upgrading the interiors to bring it to more modern, kind of market finishes to get the post renovated rents in this market. Given the demographics are so strong, we've definitely had to upgrade our finishes from what we typically do just to make sure we get those higher, class B plus rents.
So walk me through what the plan is from the exterior first, as far as exterior kind of renovations with the amenities and the grounds.
Yeah, on the exterior, a bulk of the money is going to be spent on the curb appeal. Whether that's landscaping, we're also doing exterior painting of all 8 buildings. We will obviously be rebranding this property, which we're working through as we speak. As far as the amenities go, we'll be adding a dog park, a playground, a grill area with a gazebo. We'll be upgrading the pool area, and so on. We're also going to be expanding our leasing office. There is a laundry room on site, but all of the units have washer and dryer hookups, so there is no need for this laundry room. So we could take that out and potentially make it a fitness center, expand our leasing office, or just some common space. So we're kind of working through what we could do with that space that we have there.
And so what's the overall budget that you've allocated for the exterior?
For the exterior, we've allocated, and the amenities, we've allocated about $350,000, which is about $4,000 per unit.
Okay. And then walk me through what the plan is on the interiors.
Yeah, on the interiors, this was built in the 1980s. So, kind of the basics are really well built. So like I said, washer and dryer hookups are already there, so we don't need to do any of that. So as far as finishes, we're going to be doing granite countertops throughout the units, stainless steel appliances, LVT, new cabinet fronts, new hardware, plumbing fixtures, and electrical fixtures in the units.
And then what's the budget for the interior?
It's about 700,000, which is close to 8,000 per unit.
So and that's a pretty healthy budget for a renovation on a property like this. Obviously, it's not extreme or anything like that. I'd probably call it like a moderate to moderate high, if you will, type of a renovation project. Obviously, when you include the exterior costs in there as well, now you're getting up to that kind of $12,000 or $13,000 range, somewhere around in there. So definitely a pretty hefty lift. And so what's the current in-place rents that you were on the property before you took it over?
I could probably answer that one. So when we bought it, and again, the seller had really not been keeping track with the market. He's just been operating it for occupancy. So when we bought the property, the average rents were just north of maybe $700, $725, $730. And then our plan was, after we do this renovation, it's twofold. It's one, bring everybody to market, which is probably in that high 800s, right, where they should be renting today on average. And then after doing the value add plan, get to that 1,025. So really a $300 delta from where it was when we bought it to where we want to take it.
And what was the occupancy when you took it over? The physical occupancy?
It was high, 98%, 99%.
Yeah, it's close to 100.
Yeah.
And what about the economic occupancy?
I don't think he had a single person delinquent, which I'd never. He had zero delinquency. Like I said, he's been owning this for a long time. He didn't put up with anything, so he kept it occupied 100%. Kept the rents a little lower, so he didn't have to deal with those headaches. So he had perfect occupancy.
Okay, so basically 98% physical and economic.
Yeah, no concessions, no delinquency.
Okay. All right. And so what it sounds to me like is that obviously there's some organic rent growth just from taking over the property. You could do no renovations to be able to increase the rents to the, kind of 850, 875, and but then being able to spend some money on the renovations to be able to get it to that kind of 1,000, maybe, 1,050, 1,000, maybe 75 or 1,100, depending on kind of how the market continues to increase over the next, 12 to 18 to 24 months.
Yeah, that's right. The properties that we look for are really typical of Pinetree, right? We're looking for something that has just not been run as perfectly as it should, right? And there is that organic just pop that you get just by buying the property and really raising those existing rents to market level, which the market supports. And then on top of that, doing an improvement plan where we can take those rents to the next level. So it's really two business plans that we combine into one.
Yeah, no, it's definitely interesting. One of the things that, talking about kind of the business plan and the markets and things like that you go after, one of the things you mentioned in your introduction is that you primarily go after kind of secondary markets, if you will, that have lower competition. What's the kind of overall hold period that you typically project on these types of assets?
Yeah, everything that we look at is really on a 5-year basis. It's really 2 or 3 year business plan and then a 2-year just buffer. And what I mean by that is it really, for 88 units, it really takes us 2 years, maybe a little more than that, maybe a little less than that to renovate all of the units. So the business plan itself is 2-3 years. And then we also look to hold it just for another year or two after that, stabilize the expenses so that we can look to the exit in that year 5.
Okay. And so, kind of going back to my question, not my question, my comment about your secondary and after secondary markets with lower competition, what's the impetus behind trying to go after markets that have low competition? Obviously from a buy side, it might help, but from a sell side, you actually get hurt by that, right? Because when you go, that's one of the reasons why so many people like to buy in the primary markets is because you have a lot of competition, and yes, it's harder to buy assets, but you also have the comfort of having a lot of competition when you go to sell too. So you get that kind of benefit on both sides, on the buy and the sell side.
Yeah, absolutely. So to that, what I'd say is, we're not buying in rural markets, right? We're buying in markets where they're, every property that you list will get, 10 plus bids. So there's a good, strong buyer pool. What I mean by competition is, again, Mike and I come from an institutional space, and the cost of capital for that private equity firm that's going in, they could buy a 3 cap and be happy with it because they can go and raise the debt and be fine with that. In the secondary markets, that cost of capital is higher, and the check sizes are smaller, right? Where Pinetree is a $10 million deal. No pension fund is really going to get up in the morning and start chasing these $10 million deals. So it allows us to come into these markets where we're not really competing with these very large companies. And so when I say competition, that's really who I mean. We're fine to compete, and we have plenty of competition from regional operators and even some small mom and pops, but we like to play in that space because, we've found success there, and we can be we put our best foot forward, and we can be the more quote unquote institutional group at the table just because of our experience and our reputation and the way we conduct business. So it helps us on the buy, and on the sell, we still have those competitive bids. But on the buy, where it really helps us is it really helps us take down properties where some other operators might look at something and shy away from it, or we're competing with some more mom and pop owners who who might not have the same surety of close that we do. So that's really allowed us to win some of our deals, like Pinetree, and why we're able to do it off the market.
So let's kind of move in here to the due diligence process now, kind of shift the topic a little bit. So now we're kind of like in this due diligence process. You kind of got the business plan set, you got the PSA set, you got your 30-30-30 in place. Anything happen or get found out during the due diligence process that kind of either made you kind of pause a little bit, or maybe, kind of made the lender pause a little bit? Because I know sometimes we can have that happen too.
Yeah. I like to say that we're in the business of mitigating risk. And so, this might seem a little boring, but no, when we go and tour a property, and we toured it in 2020, we toured it again in 2021, we made sure to cover all of our check boxes, right? We got all the roofers out, the electricians, the plumbers, the structural guys. We covered all of the physical needs of the properties and obviously the interiors. So we really had a good understanding of what we needed to do to the property to take it to that next level. And we had live bids and real numbers to back that up. We'd also, done a full rent roll analysis, lease audit, if you will, utility analysis. So we really knew what we were getting ourselves into. Because we're in this market, we have all of our vendors ready to go, all of our material purchases ready to go, all of our contracts ready to go, so that we're really able to reduce some of that guessing game and some of that other risk that some other operators might have, especially in a market like Huntsville. So that's why our lender really got comfortable with us. And when they asked for a lot of these due diligence items, we were very easily able to provide that because it's what we do on every single deal. So to that effect, the answer to your question is probably no. We didn't uncover anything out of the ordinary just because we'd gone so into the weeds with everything, and we already knew what to expect. And that's something we're good at.
Or the financials from this seller pretty much, in a pretty good working order, being kind of a smaller kind of operator, if you will, or was there a lot more kind of, different, analysis that you had to put together on these?
A mixed bag. The financials weren't, they weren't from a institutional quality property management company. He self-managed it. So there was a little bit of digging around that we needed to do. But at the end of the day, what we really look for are the costs that we can't really adjust, or at least adjust easily, right? Property taxes, insurance, the things that we don't really control. Once we get a firm grasp on those, call it uncontrollable items, then we're able to rely on our numbers and our vendors and our costs for creating the kind of pro forma and our forward-looking statements, which we know exactly what it's going to cost us because we do so much business with these folks. So that's where we came in and worked to our advantage. But the financials, yeah, they weren't. It's definitely not something that I would provide. We do a better job of keeping the financials, but it was what it was.
So you brought up property management. Obviously, the seller was self-managing. What are you guys doing from a property management perspective on this asset?
Yeah, we use third-party management with a group that we have all of our properties with in Huntsville. They've been good to us, and we like working with them. And so we've done third-party.
Okay, great. And they're comfortable kind of managing a smaller under 100 unit, 120 unit with the 88 units, or is that kind of the niche for that property management company is kind of like the smaller assets?
I wouldn't say that's their niche. They're a regional operator. They probably have 10,000 units across the Southeast that they manage. For us, it's kind of our niche, right? We the 80 unit, that 100 units where we could staff it as one in, one out. That seems to be working well for us. And so on top of the property management that's keeping eyes on the property, we're also keeping very tight eyes on the property, talking to property managers every day. And that's where we found success is with that kind of 100 unit, 100 to 150 unit property, just because we've been doing so many of them and we've got our processes in order for something like that.
Okay.
And one thing I'd mention is we already had 4 other properties, about 400 units in Huntsville already. So it was an easier plug and play for the property manager, even if it may be a little smaller for them.
Now, were you able to share some of the staff between the 4 properties?
We do have a construction manager in the market, so we definitely share that. And then whenever if there's more, we do all of our turns in-house also. So when one property has more make readies than the other, we could transfer staff over to from the property to property.
Okay, that's definitely nice to have that kind of economies of scale, if you will, especially working with the same kind of property management company. Now, you mentioned kind of doing your own renovations. Is that something that the property management company is managing for you, or do you have a kind of a third party? You're not a third party, but a separate kind of vertically integrated business on the side that you're using to do the renovations?
Yeah. So go ahead, Mike.
Yeah, we do all of our turns in-house. We have a construction manager, like I said, in the city. So he oversees all the maintenance techs, kind of ordering and supplies and so on for us on our behalf. So it's kind of independent from the property management firm. We do not have, call it an independent contractor that's doing this. This is where Michael and I add significant amount of value as we kind of, pick the subs, work with the subs. We source all of our supplies directly from the manufacturer, or for example, flooring, we get it directly from manufacturer, appliances, same thing there, and so on. So this is where Michael and I add significant value to the value add process to just drive costs down. And that's kind of the process that we take within Huntsville and all of our other markets too.
What are you doing from a finance or a debt perspective on this asset? I'm not doing, but what did you do to get it across the closing table?
Yeah, so on this property, we have a bridge loan. We've been doing a mix of bridge and fixed at our properties. At the time when we took the loan, bridge was really attractive, rates were low, and more importantly, the caps are really cheap. Which I think this is June 2022 when we're recording this. Market obviously changed especially with the cap perspective. But at the time, the caps were relatively cheap, and it really made sense for the deal. The loan that we took was 75% of purchase price, and then plus 100% of the capex, and it was, if I remember correctly, it was 355 over SOFR, floating for 3 years. And then the cap that we bought was also staggered. It was 150 basis points, 200, then 250, year 1, 2, and 3. So we were able to craft that to save on some costs up front, but also cover our expected rise in increases in interest rate.
Which is definitely good that you did the interest rate cap on there, because I'm sure you're probably at that cap at this point.
Yeah, we're in the money last month or this month, so we're instead of us paying now, we're getting some. So it's definitely worked out.
Yeah. Now, from an underwriting perspective, how is this increase in the interest rate affecting the cash flows on a deal like this?
Well, because we had the cap, the way we underwrote it was, we'll just assume the kind of the max, up to the cap, right? So if we have a 150 base cap, we'll underwrite that, hey, our loan wouldn't go up 150 basis points, so we're able to forecast a little better. So we were kind of, even at the beginning of the deal, we were really able to mitigate that risk, especially from a cash flow perspective. That was kind of the whole point of purchasing the cap.
Yeah, that's definitely good. It's always good to underwrite for the worst case scenario instead of underwriting for, what the current might be. And you get caught with your pants down, if you will, down the road because you didn't really plan for that. So that's great.
Exactly.
Yeah, on the flip side, to counteract, the interest rate increases, we've seen phenomenal rent growth in the Huntsville market. So we have exceeded our pro forma by 5 or 10% already in the first 6 months. So, while cash flow may have been reduced because of the interest rate increases, we're capturing that back from rent growth that we're getting.
Sure. And so as far as the premiums that you're getting right now, we talked about earlier going from like 700 to about 850, 875. Where are you seeing those organic, rent growth that's before even doing renovations on some of these assets? Where are you seeing that right now?
Yeah, our latest leases signed and then the renovated ones were probably already 50 to 100, depending on if it's a 1 or 2 or 3 bedroom above our pro forma. So call it, 5 to 10%, like Mike said, on the renovated. We've really been pushing our renewals to be pretty close to where that kind of post renovation level is. That way we could at least hit our pro forma. If people want to stay, fantastic. We're not going to kick you out by any means, but we also do have to hit our numbers. If we don't have to renovate the unit in this year, okay, we can push it next year. But we still have to at least hit those rent levels, which we've been doing. So
based on the renewals, you're trying to get to that 1,000 mark already right off the bat.
Close to it. I mean, we offer a slight discount, but for us, it's really important to get that post renovation rent. So, and the only way of doing that is to renovate the unit. So if you want to stay, we're willing to work with you, absolutely. But we've got to get pretty close to it.
So how much of the exterior have you guys already started on? Because I'm assuming that if you're going to try to increase that from, the 700 to, let's call it, 925 or 950, the residents are going to probably have to see some form of change that's happening on the property as well.
Yeah, absolutely. So,
in terms of kind of exterior upgrades, we're in the middle of painting the property right now. We have about 50% of the property already painted, and in the next couple of weeks, it'll be 100%. In terms of amenities, we've already started adding and upgrading amenities. A dog park's already there. Playground will be added in the next couple of months. The grill area will be finished up in the next couple of weeks. Pool area is upgraded already. So we're definitely showing the residents that we are putting in the capital to make the property better, and we're not just increasing rents just because of it. So they're getting a lot of value out of what we're doing as well.
Good. Now, one of the things I wanted to talk about is the structure that you kind of put together for your investors that are in this project. First off, before we dive into that, what was the overall capital requirement on this one from the equity side?
Yeah, the capital on this one was about, call it right around 3.1 million of equity.
Okay, so 3.1 million. And how did you end up structuring this with investors?
Yeah, so this was an interesting one. We actually had a family office that invested 50% of the equity as a TIC because they had a 1031. And then the rest of the equity we syndicated from our network, which was about 30 investors. So it was a mix of both.
Okay. And how did you structure that with investors?
Yeah, so in terms of structure, we kept it pretty simple. A 7% preferred return and a 70-30 split over the pref. I would mention that, one thing we really like showing our investors is that we're committed to this deal and like having a lot of skin in the game. So Michael and I personally invested 10% of the deal, which is well above the fees that we take on a deal like this. So we've actually put in capital just, kind of in and above our fee.
Sure. No, it's definitely good to see that. We don't see that very often in this space where people are trying to get to that 10% mark. So our group does that, does a very similar thing like that to try to get to that 10% on the projects that we put together, which is good to see. So it's basically, it's a 7% pref, 70-30 split above the pref. Is there any kind of catch up on the GP from the pref side from Perry Pursue, or is it just a true preferred return? 100% of the cash flows go to investors and then the rest is split 70-30.
Yep, 100% of the cash flows to the pref goes to the investors, and then it's a true 70-30 split for everything over. So yeah, we basically don't get paid unless we return a 7% and return their capital. So we're extremely incentivized.
Yeah, no, that's definitely good. I like to be able to see that. It's great to kind of see that kind of a waterfall of process that you guys have put in place there. So before we wrap it up, is there any other things that maybe we haven't touched on yet that you think might be important or interesting for us to uncover, or have we pretty much covered most of it?
Yeah, I think I'd add, as Mike mentioned on the family office side, that's always, fun for us, I'd say, because it's probably one of the more nerve-wracking parts, because when you go with a more institutional group, a private equity group, family office, right, there's a very deep due diligence period on their or due diligence process on their behalf. And so even if you have everything, you're given a lot of information, you're crossing your T's, dotting your I's, and then they have to go through a couple rounds of investment committee, and really you don't know that they're 100% in until maybe a week or two before closing. And obviously you're already hard on the money and you're already going as though you're going to close it, but there is always that remote risk that something might happen, it might not pass the investment committee. So it's really important to have those kinds of relationships and to keep that dialogue open if you're going with the more call it institutional capital. So that was definitely interesting on this deal for sure.
What was
and to add?
Go ahead, Mike.
Go ahead. And just to add, something else to that is we did a tick structure on this one, which obviously from a legal perspective, it made it a little more complicated than just our bread and butter deal that we usually do. So that was a unique experience on this one as well. Not only dealing with the family office, but structuring the tick and making sure both sides of the investors are happy.
Now, was that the first time you had done a structure like that, or had you done it in the past before?
We have done a tick structure in the past, but it wasn't for a family office, kind of an institutional investor like this. So this was definitely a more, a deeper experience that we had to go through to make sure both sides are happy and all the legal docs are to their liking.
And the lender's happy too, because they also, it's slightly different for them too. It's not out of their box, but it's a little bit different than what they do on a day-to-day. So you have to get them comfortable as well.
Yeah. Yeah, we've actually done with our group quite a bit of these type of tick structures. We haven't actually used any institutional tick structures. It's actually been our minimum investment is $1 million from a 1031 perspective. So all of them have been over $1 million. Last year we did about 50-60 million in just 1031 tick structures with the various projects that we've put together. This year we're probably already about 40-45 million, and it's just the middle of the year. But it definitely is an extra layer of complexity and a lot of extra, layer of hoops you have to go through from the lender's perspective. But it is definitely nice to have those kind of pops of equity that can come in, that can take down, large stacks of the capital or the equity stack, if you will. And it makes the raise process go a little bit smoother as well, because you can bring it all from one, not all from one, but, a large chunk from one person.
Yeah, absolutely.
Yeah. All right. So I have no further questions except for two final ones. So I said no further, but then two final ones, but I do have two final questions. They're kind of contrasting questions. I ask them on every guest. What did you find was easier during this acquisition that maybe originally you thought was going to be a little bit more challenging?
That's a good question. I would say the loan we initially thought, the loan would be much tougher, just given our past experiences with other bridge lenders. They're obviously really large companies. They don't like negotiating for a deal of this size and so on. But on this one, it was actually relatively straightforward. We think the lender really likes the Huntsville story and the market and wanted to be active in that market. They presented the best terms and try to make sure that we had a smooth closing process as much as possible when we were negotiating and so on. So that was definitely a delight to deal with them.
And then the opposite of that is what did you find was harder, right? Yeah. So.
I guess I'll take that one. And I touched on this a little bit, but it really was that whole family office, kind of more institutional. It just, like you said, it adds a layer of complexity, but it's also it's a lot of work in terms of due diligence, right? We obviously have our due diligence process, but they have one that's their own process, and they need their own documents, and just kind of scrambling in a time frame to get all that done is a little cumbersome, but it worked out in the end.
Especially at the end of the year with Thanksgiving and Christmas and New Year's and all that kind of stuff, all the different family things and vacations and stuff like that, and even a lot of the Jewish holidays. And there's a lot of extra things that are happening at the end of the year that can cause a lot of issues there. So I mean, I was going to ask this earlier, and I know I only told you 2 final ones, but here's a bonus question for everybody. So what was your contingency that you had in place if the institutional investor, the kind of family office, if you will, didn't kind of come through with their commitment for that $1.5 million, if you will?
Yeah, I think we had a couple options. Obviously, we raised, call it the 50% from our investor base. I think we had a lot of interest, and I think we could have just opened that up for another, call it the other 50%. Obviously, Mike and I could always put in some more money ourselves. So we had some contingency plans, especially on a deal with called $3 million of equity. So we had fallback plan B and plan C.
And this is the reason why we structure an extension of the PSA also, right? We could have easily exercised that. We did not. So that could have given us extra 30 days. And in that time, we could have backfilled the remaining 1.5 million or gotten the family office additional DD items or anything that they needed to make sure they're ready to go as well.
Well, and one of the nice things I like about working with 1031s is that they actually are behind a timeline as well. So
exactly,
at a certain point in time, you might be the only option for them. So then the ball's back in your court from the leverage perspective.
Yeah, that's right.
Well, gentlemen, thank you so much for jumping on and joining us on this podcast episode. A lot of different golden nuggets here. Hopefully I wasn't too hard on you, but appreciate you guys jumping on. How can the listeners reach out to you if they have further questions for you about this particular acquisition, or they want to continue to follow you more?
Yeah, and very nice talking to you, Dan. We're active on LinkedIn. We have a website, standardforcapital.com. And also we're pretty easy to get to. Michael V at Standard for Capital and Mike S at standardforcapital.com. Email us anytime.
Awesome. Well, once again, thank you, gentlemen, for coming on. Looking forward to continuing to follow you as you can close more deals here, hopefully here in 2022. And I'm having you back on for a future episode to dive into that acquisition.
Thanks so much, Dan.
Thanks, Dan.
Thank you.